week ahead is likely to be dominated by a slew of policy decisions from central banks. The Bank of Japan and the US Federal Reserve on the 19th, and the Swiss National Bank and our very own Bank of England on the 20th. As you can see from this chart coming up, the Bank of Japan is going against the flow as it tentatively looks to increase the headline cost of borrowing after the thick end of 40 years of low or negative interest rates. The other three, well, they're looking to cut, if they can, to boost their economies, but do so while keeping a close eye on their target of keeping inflation at or around 2%. They might also want to avoid doing anything unexpected to maintain financial market stability and keep volatility low also in currency markets for good measure. Now, that's a difficult balancing act for policymakers, and it is one that continues to captivate equity, bond, currency, and commodity markets, not least because central banks have tended to loosen policy by means of lower interest rates, quantitative easing, or other methods ever since the US Federal Reserve stepped in to calm markets when long-term capital management hedge fund went down in 1998. The then Fed chair Alan Greenspan orchestrated a $3.6 billion bailout to great effect, and that seemed like a lot of money back then, and it did indeed help to stop wobbling markets and give them another boost. Now, the bursting of the technology, media and telecoms bubble, the great financial crisis, the European debt crisis, and COVID-19, to name but four, have all seen policymakers subsequently step in to help to perhaps unwittingly create the idea that there is a central bank put. At the first sign of trouble, they'll step in and help investors. Now, some will argue this creates moral hazard and also encourages the very risk-taking that can jeopardize the stability central bankers are seeking to engender. If there's no penalty for taking excessive risk, as all that results is another bailout, what's there to worry about, goes the argument. That's one reason why this imminent quartet of policy decisions matters, but there are others. The thinking's as follows. First, central bank interest rates influence the return available from asset classes that are perceived to be lower risk, such as cash and bonds. Second, the yield on 10-year government bonds, known as gilts here in the UK, are seen as the risk-free rate. Any other investment should return more than that to compensate for the additional risks. Third, the lower the risk-free rate goes, dragged down by headline interest rates, the more inclined or obliged investors may feel to take risk and pay up for other asset classes such as shares. As such, interest rates affect the P in the PE or price to earnings ratio. The lower the interest rate, the higher the price or P investors may be willing to pay. The opposite applies too, though. Higher rates can mean lower multiples or a lower P in the PE, and even rates moving more slowly than expected in one direction or the other can affect sentiment and the multiple too. And finally, the cost of money also affects activity in the real economy, and therefore corporate earnings, or the E in the PE ratio. In theory, lower interest rates can boost earnings, E, and the price, P, investors are prepared to pay for them, to the benefit of share prices, since price times earnings equals share price. P times E equals share price. Equally, however, the opposite applies. Higher rates can mean lower multiples of earnings and lower share prices. So the danger to current hopes for lower rates is that the headline cost of borrowing stays higher for longer than expected, or heaven forbid, even unexpectedly goes up. With regard to that final point and how returns on cash and bonds compare to those available from equities, two of the companies whose shares offer some of the highest dividend yields in the FTSE 100 are scheduled to report in the coming week. They are pensions and savings provider Phoenix on Monday the 17th and fund management giant M&G on the 19th. In addition, we also get full year results from another major financial stock, life insurer and asset manager Prudential, the former parent of M&G, also on the 19th. Now, as I sit here, Phoenix and M&G are actually the two highest yielding stocks in the FTSE 100 based on consensus analyst forecasts for their dividend payout in 2025. Prudential, by the way, ranks 65th on a forward yield of 2.6% based on the same consensus forecast. Analysts and investors will therefore watch for not just the full year payout for 2024, but any guidance for 2025. For the year just ended, however, the consensus forecast for dividend payments are as follows: 54.4p a share at Phoenix, up 3% against 2023, 20p a share at M&G for a 2% advance on the prior year, and 17.9p a share at Prudential, up 9% year on year. Income seekers may therefore pay close attention to these results, although they should ask themselves why the market is demanding such a high yield as compensation for the perceived risks involved, and indeed therefore what those risks might be. whether it's a lack of growth or competitive threat or regulation, for example. Investors must then decide whether the yield is sufficient compensation for those dangers or not, and that's something they can only do based on their own judgment and their own research. For the record, just to finish off, in terms of the quartet of big central bank meetings in the coming week, the Bank of Japan is expected to leave rates unchanged at 0.5%, a 17-year high. The US Federal Reserve is forecast to stand pat as well at 4.5%. The Swiss are expected to cut by 1/4 percentage point to 0.25%. And the Bank of England is expected to sit still and leave the base rate at 4.5%, but lay the groundwork for 2 more quarter-point cuts to 4% by year end. In each case, the minutes of the policy meetings, voting patterns, and the commentary offered may be just as important as the decisions themselves. I hope that you and your families are all keeping well. Thank you for watching, and I look forward to seeing you again next time.